Welcome back. Wrapping up this week's trading, S&P 500, we can see with a blue line here, maintained a pretty quiet trading range, hitting highs just under 4140 and lows around 4120. Wrapping up this week at a close of 4124, near the lower end of the range, but a very tight trading range. We can see from this perspective, the yellow dots represent the closing prices. The red line represents a low of the week. The blue is a high of the week. This is the tightest trading range we've seen in quite a while. Now, quiet stock markets tend to lead to very explosive stock markets. It doesn't mean it's going to happen, the next trading day. But these quiet markets, in a sense, the market's kind of building up tension and trying to make a decision which way to go. So I don't think that we should necessarily be lulled into a false sense of complacency. Taking a look at the following chart, the red line is the S&P 500. The white histogram bars represent the Friday close as a percentage of the week, meaning if Friday represents the high of the entire week's trading range, we would see histogram bars up near the 100% level. If the Friday's close represents or close near the lower end of the week, we would see histogram bars near the low. We closed about 26%. So we're closing near the lower end of the week. Now, it doesn't mean, I don't think, as much when you have such a quiet trading range, but it is important to note that, at the end of the day, the stock market moves under the weight of buying and selling pressure. And the fact that we're closing near the lower end of the week certainly shows us that there's more of a consensus to the downside. Again, it's a very quiet trading range, so I wouldn't look too much into that. With that said, this is today's change in treasuries in basis points. This represents the yield. The 1 month bond, 1 month T-bill up 31 basis points today. 2 month down 17. Everything else is very, very quiet. Current U.S. Treasuries stand as follows. 581 on the 1 month. That's very, very high. Higher than the 2 month at 482. And the 4 month at a 523. Notice the 10-year bonds at a 339. So we have quite the disparity. Again, we've spoken about this quite a bit. The bond market, the yields in the bond market tell us where the bond market, and we could say, the overall economy, where's the expectation as far as interest rates. The short-term yields, such as the 1 month, the short-term maturities, I should say, near the 1 month T-bill, the 2 month, etc. That gives us an idea about the immediate expectation. Where do we think interest rates are going to be now and in the near-term future? Well, we had a slew of economic numbers, CPI, PPI. We recently had a Federal Reserve meeting, jobs numbers as well. So putting all that together, the bond market's telling us that the bond market believes that higher interest rates are here to stay in the immediate term future. But looking to the long-term future, 10-year bond at a 339, the 7 at a 337, the long-term future, the bond market sees lower yields, not as favorable economic conditions. This is the 1 month change. The 1 month T-bill up 35% in yield. That's where the money has been flowing, moving out of the 1 month, and that's why the yield goes up. Yield goes up when prices go down. This is this month in bonds. The blue histogram bars represent the S&P 500. Very quiet trading range for about a month now. The black dotted line here is a 1 month T-bill. We had the 1 month T-bill at a 336 yield the third week in April. From 336, we're now at 581. That is a tremendous move up. The 2 month is actually going down. Everything else looks like it's softening. The red line, the red dotted line at the bottom, that's a 10-year bond. There really is a very definite movement. In the near-term future, higher interest rates are expected. Now, moving forward, how can we use this information? Well, we look at economic numbers, and the economic numbers are going to tell us one of two stories. Either that the Federal Reserve, whatever number it is, the Federal Reserve, number one, may have more credence to raise interest rates. Let's say, jobs numbers look better, and it looks like the economy can support higher interest rates. And that will happen if the jobs numbers, for example, are good. Then we'll say, hey, the jobs numbers are good and therefore no problem. They can raise interest rates. Or conversely, if the numbers are weak. And that's the jobs numbers represent growth. We also look at durable goods, manufacturing, auto sales, things like that. That all indicates the level of growth in the economy. The other side of the coin is inflation. What do the inflation numbers tell us? Does the Federal Reserve have a reason to continue to raise interest rates? It's a careful balance between reason and ability. If inflation is going up, the numbers are a little soft this week, CPI, PPI, but they didn't really go down. They're a little bit under expectation, a little bit soft compared to last month, but Federal Reserve speakers themselves said not enough of a softening in order to justify the end of the interest rate hikes. This is the 10-year 1-year Treasury. Red line is a 1 year, blue line is a 10-year. The widening between the two is just an extension of the inversion. And we can see here the histogram bars at the bottom show us exactly how big that inversion is. That's a 131 spread. Intraday, we've seen it even higher. But that, as if that's not enough, take a look at the black line. That's the 1 month. The black line, the 1 month T-bill, April 20th was at 340. The 10-year, the purple line, was at 357. So they were very close. In the past 2 weeks, we've seen, while the 10 years really kind of softened, we went from 357 to a current 339. Down, maybe less than 20 basis points. The 1 month T-bill, 336 to a 581. So that's 250 approximate basis points, 2.5%. That really does tell the story as far as where we sit. And what the bond market's telling us. It's telling us in the near-term, immediate future, we don't have anything on our list at least that's shorter than a 1 month T-bond. It's telling us in the immediate future, the Federal Reserve, first of all, has reason to continue to raise interest rates, and number two, believes that the economy is strong enough to withhold, or not to withhold, but to sustain, to endure higher interest rates. The long-term bond yields tell us a different story. Now, the blue chart on the left-hand side, that shows us the current Treasury. It's actually January of 2023. Shows us the yield spread. We have the 1 month T-bill on the left-hand side, 3 month, all the way up to 30-year. And the histogram bars obviously show us the amount of yield. Well, in January, this is what the bond market looked like. The 1 month at a 458, the 2 month at a 470, all the way up. The highest yield was 480. The 10-year was a 352, and again, the 6 month bond was at a 480. That represents the highest yield at the time. Well, take a look to see how the bond market has progressed from January. This is now February. The 6 month bond is still the highest, now at a 517. The 10-year at a 392. Now watch, especially on the short-term maturities, how these lines change. This is February and now March. The highest yield is now the 4 month. Remember, it was the 6 month, now it's the 4 month. Now from March to April, now the 4 month moves up to a 520. In March, the 4 month was 497, April 520. Now watch what happens in May, so far in May. Watch especially the 1 month T-bill, which in April pays a 435, and in May pays a 581. Notice what happened? The highest yields are moving to the left side of the charts. From January, February, okay, March, April, present day May. During that period of time, also, the 10-year remains very, very low. This is the pattern we're seeing right now. Well, we've seen this pattern in the past. Take a look at the right-hand chart, the red chart. That's January 2007. Notice the 4-month was the highest yield at a 516. The 10-year was at 483. The 1-month T-bill is at a 5. So the 1 month at a 5, the 4-month at a 516. That's January 07. February 07. We go from 5 to 524 on the 1 month. March, April, we go back. Now, it doesn't mean it's going to happen all at once. The market will shift back and forth. Now we see the 1 month T-bond fall back from 5 to 480, and then the yield switches. What I think, if we were to look back at the economic calendar at that time, and I'm just guessing based on the movement of the bond market here, the highest yield is being traded back and forth between the 4-month and the 1 month. Well, based on the economic calendar at that time, it probably showed us, well, one number says, hey, higher interest rates are here only for the near-term future, and that's when the 1 month bond surged, the 1 month T-bill surged. But then we had a piece of economic news that says, no, the economy looks a little better. I think the Federal Reserve is going to raise interest rates for the foreseeable future, and then we have the 4-month take the highest place. Meanwhile, notice the 3, 5, 10 years, they're kind of staying near the lower end of the range. This is May. Now the 30-year surges. It looks like there was some real. Remember, this is still early 2007. Maybe a resurgence in hope for stronger economic conditions. June 07. This is July. All of a sudden, we see the 1 month T-bill start to fall to the downside, to rally up, and the longer term bonds fall to the downside. August, we have a flattening. That's August, that's September, October. Now watch, the 1 month T-bill was at 5, now we're at 401. October 2007, we're at a 4% yield. November, the 1 month T-bill drops down to a 363. Remember, the 1 month tells us most likely what's going to happen in the near-term future. The 1 month T-bill, December 07, 276. We were 5%, now 276, within just a matter of months. Now, this is January 08. This is when we start to really send some troubles out there. The 1 month T-bill is at a 164. And we can continue. We can see February, for example, March. And we start to see lower yields, the 1 month at a 122, and lower yields. The 1 month is dragging the rest of the yields down. You see, what happens is when we enter a period of economic calamity, the short-term maturities react first. But then, as it becomes more of a certainty that we're running into troubled waters over here, March 2008, certainly we're at the cusp of that. Then the longer term maturities are telling us, hey, the 1 year, the 2 year, things don't look good. I think we're going to have lower interest rates for a while. Now, we take a look. This is May 07. And we see on the left-hand side, the white line is a 1 month T-bill. This starts in May of 07. Take a look what happens. All of a sudden, the 1 month starts to lead us lower. By the time we're at August 07, we start to see the 1 month really drop down. Let's fast forward to, let's say, starting November 07. Take a look at the 1 month traveling down. That's the white line, followed by the red line, the 1 year, then the 5 year and the 10 year. And that's when the stock market really starts to break. And that leads us to where we left off, March of 08. And we know what happens after that. So point being that right now we're seeing a surge in the 1 year bond, or the 1 month T-bill. And that probably, it's kind of hard to, put our finger exactly in where we are. But if we go back to December '06, first quarter '07, the white line again is a 1-month T-bill, and take a look at the stock market. It was quite strong and even continued through April. What we want to be on the lookout, if we're of the opinion that we're going to see lower markets in the future, we want to see a turn of the 1-month T-bill move down. And then remember, it really, when it goes down a lot. In '07, '08, we saw the 1-month drop from 5% down to 2%, even below that. If we're of the opinion that this is a temporary period of economic difficulty, and we see longer term, we see better economic conditions, then we would look to see the longer term interest rates start to rise. Such as the 10-year and also the 30-year. So the bond market, we're going to try to remain very objective, and then we're going to wait for the bond market to give us our cues, and see also, I think it's very interesting to see how the bond market reacts to the economic calendar. So we're going to watch these and many other numbers very carefully. We hope this has been helpful. We look forward to seeing you back soon.